Hey everyone, welcome back to Corporate Decoder, the place where we sift through corporate documents so you don't have to. Today we're diving into the filing of T. Rowe Price OHA Flexible Credit Income Fund. Sounds like a snooze fest, right? Well, let's see if we can uncover any hidden gems or disasters. After all those numbers and all those promises, does it all add up? Let's find out. Bottom line for today's video, we're checking into this filing, which is basically all the legal paperwork of a new fund trying to get going to see how they say they're going to make money for their very select group of investors. Before we get started, if you find value in translating corporate jargon into simple insights, make sure to hit that like and subscribe button. It will help the channel out a lot. Also, come join our growing community on Discord. The link will be in the descriptions. The scroll is filed with CUF, Securities and Exchange Commission on June 18, 25 scroll. First off, this is a registration statement filed with the SEC, and it was done in June of 2025. This fund is registering under the Investment Company Act, and it's also amending a previous registration. This is the 6th amendment, actually. They're not sure on the precise date for when they're planning to offer this to investors, but it'll happen, they say, as soon as they get the go-ahead from this filing. This is all the paperwork you have to do to begin to sell your fund to investors. So what actually is this thing? The fund calls itself T. Rowe Price OHA Flexible Credit Income Fund. Big name, right? So it's set up as a closed-end investment fund managed by OHA Private Credit Advisors, which itself is now part of T. Rowe Price. Being closed-end means investors can't just redeem their shares whenever they want like a regular mutual fund, but they do have quarterly offers to buy back at least 5% of the outstanding shares. So it's not super liquid or easy to get out of. Speaking of the fund, their investment objective is to produce current income. Basically, they want to generate cash for their investors. They plan to make that income by investing across a wide range of what they call credit strategies. More on how they are going to do that later. Under normal market conditions, that fund intends to invest 80% of its money in what it's calling credit. That includes direct lending, junior capital solutions, asset-based lending, structured credit, special situations, and liquid credit. That's kind of a word salad, but those are different kinds of debt. Some are safer, some are riskier. I'll try to explain them. Junior capital solutions basically mean riskier debt like unsecured debt, loans where they're second in line to get paid back, or mezzanine loans. Structured credit includes things like COOs, SCLOs, or collateralized loan obligations are like bundles of loans, mortgages, or in this case, corporate loans. So they pull a bunch of loans together and sell off different slices or tranches based on their risk and return. Special situations usually involves investing in stressed or distressed debt. That means they're buying up the debt of companies that are having a hard time, either because they are stressed or in distressed situations. While some of the loans in which the fund intends to invest pursuant to the foregoing may be secured, the fund may also invest in debt securities that are either unsecured, SECRO'd, but the fund has the flexibility to also invest in debt securities that are either unsecured or which are subordinated to substantial amounts of senior indebtedness. So that is also not great since they are lower in priority. Scroll situations at strategy may vary over time. Under normal circumstances, the fund expects its allocations to each strategy will be within the following range. So how do they expect to split up those types of investments? They have a chart for that. Direct lending can be anywhere from 0 to 50%. The smallest is special situations at 0 to 30%. The smallest is special situations at 0 to 30%. But this can change. What makes them different from other funds? According to the report, they're going to focus on larger borrowers, companies generally with earnings of at least $75 million. They have a good handle on this market, being specialized on credit for 30 years, having more than 120 investment professionals globally. They want you to know they have a library of knowledge on issuers. Speaking of what they want the world to know, the management team is targeting companies with earnings before interest, taxes, depreciation, and amortization, or EBITDA of $75 million or greater. They may also borrow money, which is the use of leverage. They want to use leverage opportunistically to give themselves more firepower, but they are not going to have leverage through preferred stock in the next year. Net assets means everything you own minus all of the current liabilities. Let's see what this will cost you in fees. They're charging a base management fee of 1% of the fund's net assets annually. But that's not all, because there's also an incentive fee of 15% of the fund's pre-incentive fee net investment income over a 6% hurdle rate. So they're taking 15% on top of what they are making if it's over that hurdle. That is an interesting incentive. One way to look at it is that it could incentivize the advisor to make riskier investments that could possibly benefit the fund, but also potentially harm it. But the good thing is the advisor has agreed to waive its management fee and incentive fee for some time after the fund is launched. During that time, they will also reimburse the fund's initial costs, as long as combined expenses are over the expense cap of 1%. But get this, once the fund actually does start earning some income, the advisor gets to recoup all those waived fees. It is interesting that there are fees for basically getting out as well. There's a 2% early withdrawal charge on shares repurchased within 365 days of purchase. I'm thinking long term is really needed for this type of investment since they make it hard to get out early. This charge is good because it helps the investors already invested avoid getting the value of their holding invested, avoid getting the value of their holdings diluted. Let's check the fees with these guys. We'll see what the estimated expenses would be on $1,000. The main thing to look at here, after 1 year, they estimate expenses to be $84 on a $1,000 investment for Class A and $59 for Class D and $41 for Class I. It all goes higher from there. So an investment in this fund could get pretty expensive, but this is an estimate, so of course it all depends. Scroll investment in any share class of the fund represents an investment in the same assets of the fund scroll. Scroll now some important words about share classes. The fund intends to offer 3 classes, A, D and I, but they were very clear that an investment in share class represents an investment in the same assets of the fund. So there are no differences in what you're invested in based on the differences of the classes. Scroll investing in shares involves a high degree of risk. See types of investments and related risks beginning on page 25 of this prospectus scroll. As in all SE filings, there's an entire section on all the possible ways this fund could lose your investment. They call it the risk factors, so you really should read that to make sure you know what you're getting into. We can't go over them all, but we'll touch on a few. There is some limited liquidity in this fund as opposed to more liquid stocks. Since the fund has global exposure to many different countries, it's exposed to changes in currency exchange rates. And those SIC lows, those things we touched upon earlier, well, they can carry significant risks and losses if the underlying collateral performs poorly. They also are highlighting that the fund may borrow money, which of course has the potential of amplifying losses. Finally, to give you one more important risk, since the fund is trying to have a special tax designation, real estate investment conduit then may not be able to do what it wants to follow that regime. If that happens, that could have poor tax implications for the fund and for shareholders like yourself. Under normal circumstances, the fund intends to invest at least 80% of its assets in credit crawl key, because this fund intends to invest 80% of its assets into credit. There is something called the 80% policy. The 80% policy is a regulatory commitment that requires a fund to invest at least 80% of its assets in the investments in the category implied by its name. I'm just going to give you a brief overview of other things they might put money into: notes, bills, other instruments and preferred securities, municipal obligations, stock, short sales and derivatives. They could use derivatives to try and lower risk, but derivatives are a double-edged sword and create impermanent hedges. Scroll the fund is an interval fund, coda type of fund which, to provide some liquidity to shareholders, makes quarterly offer scroll. Because the fund is an interval fund, there are some things such as withdrawal fees to keep in mind. Specifically, they have an early charge which applies if you sell your shares before 1 year. This is used, of course, to dissuade short-term investors who do not serve the fund's long-term goals. Scroll should be the act of the shareholders with respect to any matter submitted to TOTS a vote of the shareholders. Scroll so that to court than shareholders have in such funds. This is important for accountability and transparency reasons. So the shareholders do have a say in determining matters that come before them, because they can specify a greater or lesser vote requirements for any matter submitted to a vote of the shareholders. Let's scroll down all the way to the list of what the fund cannot do. It's so-called fundamental investment restrictions. First, they're restricted from anything with commodities. They're a low commodity fund, but they can purchase and sell real estate, as they are not allowed to underwrite securities, meaning they can't make an IPO, initial public offering. So they're restricted from making loans to other people, but they can technically do short positions. Exit may not invest more than 25% of its total assets into one industry. So this fund will be diversified in terms of exposure to different industries. Scroll as an interval fund must calculate the share price. and it's least a weekly basis scroll kit, and something that they note that they, as well as an interval fund, must calculate the share price on a weekly basis and also daily for the 5 days before repurchase request deadline. Finally, it might be good to know who is in charge. The document also tells us the names and backgrounds on some of the people on the portfolio management team. However, since the fund has no employees, it depends on the advisor to do things competently. The fund lays out how they're potentially in danger on that point too, and that makes sense to call out the experience and reliability of the people involved. But to qualify and remain the special treatment of real estate investment conduits and their shareholders, the fund must meet certain source of income, asset diversification and analytical disruption requirements, and failure to do so could result in the loss of rice status. So the tax implications are another danger to be concerned of. Alright, this is quite a journey through legal paperwork. Let's step back and make some broad opinions and assessments. Overall, what is interesting about what I'm hearing about is this fund has expertise in lending and wants to provide it for retail investors through closed-end regular distributions. The part about distributions is really interesting because they're going to have to distribute money from somewhere, even if they are not making returns yet. That can potentially erode assets. That 2% fee is also pretty intense if a customer decides to cash out their shares before a year is up, so people will want to only invest with absolute faith that it's locked up for the year or more. I can understand the risk from the manager's perspective though, but overall I think that the business idea seems okay. Also, the high management fees and the existence of incentive fees seems excessive, as well as there is still execution risk due to the competition FIC. These are new funds, so it remains to be seen the existence of incentive fees seems excessive, as well as there is still execution risk due to the competition. That these are new funds, so it remains to be seen if they can grow it effectively. Alright, that's our breakdown of T. Rowe Price OHA Flexible Credit Income Fund's latest filing. It's more of a business overview and less than an actual report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.